Have you ever wondered why some people with modest salaries end up financially secure, while others earning millions still find themselves stressed, broke, or constantly chasing more? Money, after all, is not simply about math. If it were, the richest people would always be those with the highest incomes and the smartest strategies. But life doesn't play out that way. Money is emotional, it's psychological, it's tied to our fears, desires, upbringing, and habits more than to calculators and spreadsheets. This is the central theme of Morgan Housel's book, The Psychology of Money. He argues that managing money well is less about intelligence and more about behavior. You don't need to be a genius to build wealth. You need patience, discipline, and perspective. And the biggest obstacles you'll face are not in the markets or the economy, but within your own mind. Housel begins by reminding us that financial success has little to do with knowing formulas and theories. It has everything to do with how you behave when faced with uncertainty, when greed whispers that you need more, or when fear pushes you to sell too soon. A brilliant investor who lacks control over their impulses will fare worse than an average person who stays consistent and calm. One of the most powerful stories he shares is about Ronald Reed, a janitor and gas station attendant who lived a humble life. He never earned a high salary, but he quietly invested small amounts, lived frugally, and let compounding work its magic over decades. When he passed away, he left behind over $8 million for charity and family. Contrast that with Richard Fuscone, a Harvard-educated Merrill Lynch executive who earned millions during his career but lived extravagantly and borrowed recklessly. When the 2008 financial crisis hit, he declared bankruptcy. The lesson? Wealth is not about income, it's about behavior. It's about how much you keep, not how much you make. Housel calls this the difference between being rich and being wealthy. Being rich is about having a high income or visible possessions, cars, houses, clothes, vacations. Being wealthy is hidden financial resilience. It's the money quietly sitting in your accounts, the freedom to make choices, and the security of knowing you don't need to live paycheck to paycheck. Wealth is invisible, and many people mistake being rich for being wealthy. The problem is, chasing rich often destroys the chance to become truly wealthy. Another lesson Housel emphasizes is the role of luck and risk. Success stories often celebrate hard work and intelligence, and while those matter, luck is always a hidden player. Bill Gates became one of the wealthiest men alive not only because of talent and determination, but also because he happened to attend one of the only high schools in the world with a computer lab in 1968. Countless other students were equally intelligent but never had that opportunity. Similarly, failure often comes not just from mistakes, but from bad luck or circumstances beyond control. This doesn't mean effort is meaningless. It means humility is essential. When judging others' financial outcomes or even your own, you must acknowledge the invisible role of chance. Housel also dives into the strange way compounding works and why so few people truly understand it. Compounding is not just about steady growth. It's about exponential growth that becomes enormous only after a long time. Warren Buffett is often praised for his skill, but Housel points out that much of his wealth came simply from staying invested for decades. He began investing as a child, and by the time he was in his 60s, he was wealthy. But most of his fortune actually accumulated after that age. Patience was the real secret. Most people never give compounding the time it needs because they are too eager for fast results. They underestimate how small, consistent actions can snowball into life-changing outcomes if left untouched long enough. This is why Housel stresses that time in the market beats timing the market. Nobody can perfectly predict short-term movements. The winners are those who can endure, stay invested, and resist the urge to constantly change course. The psychology of patience is far more valuable than the illusion of control. Through these early lessons, Housel sets the stage for a powerful truth. Money is not a math problem, it's a behavior problem. Our instincts, biases, and emotions constantly interfere with rational decision-making. To succeed financially, we don't need more IQ. We need to master our psychology. One of the most liberating ideas Morgan Housel presents is that money, at its core, is a tool for freedom. It is not about the luxury cars, the expensive vacations, or the big houses. It's about the ability to wake up every morning and have control over your time. True wealth, he argues, is the freedom to choose what you do, when you do it, and who you do it with. Everything else is secondary. Think about how much of modern life is dictated by obligation. Working hours you don't like, saying yes to people you'd rather avoid, or sacrificing personal goals because of financial necessity. Money, when used wisely, can buy you independence from those obligations. It allows you to say no. It gives you options, and often that freedom brings more happiness than any visible display of wealth ever could. But here's the paradox. Many people chase visible symbols of wealth precisely because they want respect and admiration, when in reality, wealth that is displayed is wealth that is gone. The flashy car in the driveway is not a sign of deep financial security. It's proof that money has already been spent. Real wealth is what you don't see. The investments that have quietly grown, the savings that ensure you can handle emergencies, and the time you've bought back for yourself. Housel tells us that people don't actually want money itself. They want the lifestyle, the respect, or the freedom they believe money can bring. But ironically, chasing outward appearances of wealth often sacrifices the very freedom people crave. A person who takes on debt for luxury items may feel rich in the short term, but ends up trapped in obligations that erode happiness. This leads to another important lesson. Wealth is relative. What feels like abundance to one person might feel inadequate to another. There is no universal benchmark. Someone living comfortably on a modest salary, debt-free, and with time to spend as they wish may feel far wealthier than a millionaire tied to long work hours, financial stress, and never-ending comparison to even richer peers. Understanding this relativity is critical for finding contentment. Housel also explores the psychology of happiness and its connection to money. Research consistently shows that beyond a certain point, enough to cover needs and some comfort, more money does not necessarily equal more happiness. What drives happiness is the sense of control, security, and meaningful use of time. Studies have found that people value experiences over possessions because experiences create memories, connections, and meaning, while possessions fade in excitement quickly. And yet people often underestimate how easily happiness adjusts. When we buy something new, the thrill is real but fleeting. Humans adapt quickly, and what once felt like luxury becomes normal. Psychologists call this the hedonic treadmill, the tendency to quickly return to a baseline of satisfaction despite gains in wealth or possessions. This treadmill keeps people chasing more, convinced that the next purchase will bring lasting joy, when in reality it rarely does. So, if happiness doesn't scale endlessly with wealth, how should money be managed? Housel's answer is, aim for enough, not endless growth. Define what is sufficient for you and stop tying your satisfaction to comparisons with others. The danger of comparison is that there will always be someone with more money, more success, more recognition. If you measure yourself against them, you will never feel wealthy, no matter your actual situation. The antidote is gratitude and clarity about your own goals. At the same time, Housel is clear that saving is one of the most powerful behaviors you can cultivate. Saving gives you options. It builds resilience. It ensures you can withstand shocks and still stay on course. Importantly, saving is not about being cheap or depriving yourself. It's about creating freedom and flexibility for the future. He stresses that wealth is built not only by making money, but by keeping money. And keeping money requires restraint, patience, and the ability to live below your means even when you could spend more. One of the most underrated benefits of saving is peace of mind. Imagine the confidence of knowing that an unexpected bill, a job loss, or a downturn in the economy won't destroy you. That sense of security is priceless. Housel argues that while investing is often romanticized as the way to get rich, saving quietly does most of the heavy lifting. In fact, how much you save matters more than how well you invest, especially in the beginning. A person who saves consistently, even with average returns, will almost always outperform someone who invests brilliantly but inconsistently. This ties back to the psychology of money being more important than the mechanics. It doesn't matter if you know the best investment strategy if you can't stick with it. What matters is whether you have the discipline to save, the patience to wait, and the humility to recognize that your goals may be different from everyone else's. Housel also cautions against the dangerous pursuit of always wanting just a little more. Greed, he explains, is one of the most common reasons people lose everything. They don't know when to stop, when to say enough. History is filled with stories of investors who were already wealthy but kept reaching for more until they risked too much and lost it all. The line between ambition and greed is thin, and the difference often lies in having a clear sense of what is enough for you. Ultimately, money is a mirror. It reflects your values, your habits, and your psychology. If you're anxious, insecure, or envious, money will magnify those traits too. If you're disciplined, patient, and grounded, money will amplify those qualities too. The way you handle money is not separate from who you are. It's a direct expression of your character. By reframing money not as a scorecard but as a tool for freedom, Housel gives us a new way to measure success. It's not about having the most, it's about having enough, living with peace of mind, and using wealth to align life with your values. Money is never just about numbers. It is about uncertainty. Every decision you make with money carries an element of risk because the future is unknown. Morgan Housel emphasizes that risk and luck are two sides of the same coin. Both are outcomes shaped by forces outside your control. This perspective reshapes how we think about success. People often look at the wealthy and assume their fortune is entirely the result of intelligence, hard work, or skill. And while those play a role, luck is just as powerful. Being born into the right family, in the right country, at the right time, can determine opportunities in ways we rarely acknowledge. Consider Bill Gates. Yes, he was brilliant and hardworking, but he also attended one of the only high schools in the world that had a computer terminal in the 1970s. Without that rare chance, the story could have been very different. The same is true in reverse. Failure is not always due to laziness, incompetence, or poor judgment. Sometimes it's simply bad luck, being in the wrong place at the wrong time. Recognizing this truth should make us more humble when judging others and more forgiving toward ourselves. Success is never entirely deserved, and failure is never entirely our fault. But if luck and risk are so influential, how should we make financial decisions? Housel's advice is to plan not as if you know the future, but as if the future is uncertain, which it always is. That means building in a margin of safety. It means accepting that unexpected events will happen and preparing for them, rather than pretending you can predict them. For example, investors often try to time the market, guessing when to buy or sell. But the reality is that nobody can consistently predict short-term movements. Even experts fail. The smarter approach is not to aim for precision, but for resilience. Instead of asking what will happen next, a better question is, how can I survive if I'm wrong? This mindset applies beyond investing. It touches every financial decision: the size of your emergency fund, the kind of debt you take on, and how aggressively you pursue growth. When you expect uncertainty, you make choices that give you breathing room. You save more than you think you'll need. You avoid putting yourself in positions where one mistake can wipe you out. You recognize that the world is always changing, and your plans must be flexible. One of the dangers Housel warns against is overconfidence. People love to believe they are smarter than the market, that their judgment is superior. But history shows that even the brightest minds can be humbled by events they didn't foresee. Overconfidence is seductive because success breeds it. If you make money on a few investments, you begin to think you have a special ability. But sometimes those gains are just luck in disguise. This is why humility is such a valuable financial trait. Humility reminds you that you don't know everything, that you can't predict everything, and that caution is wise. It pushes you to diversify, to save, and to avoid putting all your eggs in one basket. Humility doesn't kill ambition, it tempers it with realism. Housel also introduces the idea of tail events, the rare, extreme outcomes that shape history. In investing, most of the market's long-term returns come from a small number of extraordinary days or companies. Missing them makes a huge difference. Similarly, in life, a few pivotal moments, meeting the right person, choosing a certain career, avoiding a disaster, can outweigh years of steady effort. This is why it's dangerous to judge success or failure based on a small sample. What looks like brilliance might just be the benefit of catching a lucky tail event. If tail events are so influential, then surviving long enough to benefit from them becomes critical. This is why Housel says that staying in the game is more important than playing the game perfectly. Endurance beats brilliance. The investor who stays invested, even through downturns, often ends up wealthier than the one who tries to outsmart the system but gets wiped out by a single bad bet. This lesson applies to careers, businesses, and personal finance alike. Survival is victory. Avoid catastrophic mistakes, and you give compounding the time it needs to work its magic. Compounding, after all, is the quiet force behind most wealth. It doesn't reward speed, it rewards consistency and time. But compounding only works if you remain standing. Another aspect of risk is that it feels different in hindsight. Once an event has happened, it's easy to look back and say, that was obvious. But at the time, uncertainty is always messy and confusing. The danger of hindsight bias is that it makes us overconfident in our ability to predict. We forget that history looked uncertain when it was unfolding. To guard against this, Housel suggests humility again. Accept that you don't know what's coming and structure your finances so you don't have to know. There's also a psychological side to risk tolerance. Not everyone can handle the same level of uncertainty. Some people can ride out big swings in the market calmly. Others panic at the first sign of trouble. There is no right or wrong. It depends on your personality, experiences, and emotional resilience. The danger comes when you try to copy someone else's strategy without understanding your own tolerance. A plan that works for them may not work for you if you can't stomach the volatility. That's why personal finance is, above all, personal. The best financial strategy is not the one with the highest potential returns, it's the one you can stick with. A mediocre plan followed consistently is better than a brilliant plan abandoned halfway through. Risk, then, is not just about numbers and probabilities. It's about psychology. It's about knowing yourself, your limits, and your needs. The goal is not to eliminate risk. That's impossible. The goal is to manage it wisely so that uncertainty doesn't derail your long-term goals. In the end, Housel wants us to respect luck, respect risk, and respect time. Recognize how much is outside your control and focus on what you can control: your behavior, your savings, and your patience. Success with money is less about being right all the time and more about being resilient when you're wrong.
If money were only about numbers, spreadsheets would make us rich. We could calculate the perfect savings rate, the perfect investment strategy, and the exact moment to buy and sell, and follow it like a formula. But the truth is very different. Success with money has less to do with knowing what to do and more to do with whether you can actually do it. In other words, behavior trumps knowledge. This idea is at the core of Morgan Housel's philosophy. He argues that financial outcomes are driven not by intelligence or data, but by psychology, habits, emotions, and beliefs. And the most important psychological battle you will ever face is not against the market, not against the economy, but against yourself. Consider greed. It is a powerful force, often disguised as ambition. A person who once dreamed of earning enough to live comfortably reaches that milestone, and suddenly the bar moves higher. Enough is no longer enough. They want more not because they need it, but because they see others with more. The comparison trap fuels endless dissatisfaction. As Housel points out, people don't measure wealth in absolute terms, they measure it relative to those around them. This is dangerous because comparison is infinite. No matter how much you have, someone else will always have more. If your happiness depends on being at the top, you're setting yourself up for disappointment. Chasing the moving target of enough often leads to unnecessary risk-taking. People stretch their finances, invest recklessly, or take on debts just to climb higher in the status ladder. Ironically, in trying to look rich, many destroy the foundation of actual wealth. Housel makes a distinction between being rich and being wealthy. Rich is visible: big houses, luxury cars, and expensive clothes. Wealth, on the other hand, is invisible: the savings, investments, and assets that provide freedom and security. You can see when someone is rich, but you can't see when they are wealthy. And often, those who look richest are not truly secure because they are spending everything they earn, or more. This is why humility and restraint matter. Real wealth is created by not spending all of your income, by saving and investing quietly. It doesn't scream for attention. In fact, many of the wealthiest people live below their means. They don't feel the need to prove anything to others because they know their security is intact. The paradox is that the people who flaunt wealth often have the least of it, while those who keep quiet often have the most. Managing behavior also means managing expectations. Many financial disappointments come not from actual losses, but from expectations that were set too high. If you expect 20% returns and get 10%, you feel cheated, even though 10% is extraordinary. If you expect luxury and get comfort, you feel deprived, even though comfort is more than most people have. Happiness, in money as in life, is the gap between expectations and reality. By controlling your expectations, you increase your satisfaction without changing your circumstances. Another behavioral challenge is the illusion of control. People like to believe they're in charge of their financial destiny, that their decisions alone determine outcomes. While discipline and planning do matter, external forces, luck, risk, timing, always play a role. Believing otherwise creates frustration when things don't go as planned. Worse, it may lead you to double down on mistakes, convinced that you can force the outcome you want. This ties into one of Housel's most profound lessons. Personal finance is not about maximizing wealth, but about maximizing freedom. The ultimate dividend of money is control over your time. It's the ability to wake up and decide how you'll spend your day. True wealth is not a bigger house or flashier car. It's the absence of being forced to do something you hate. When you recognize this, your relationship with money changes. You stop asking, "How can I get more?" and start asking, "How can I use what I have to live better?"
The behavioral side of money also reveals itself in how we respond to fear. During market downturns, many investors panic and sell at the worst possible time, locking in losses. Rationally, they know markets recover, but emotionally, the fear of loss is overwhelming. Behavioral economists call this loss aversion. The pain of losing is felt more strongly than the joy of gaining. To succeed with money, you must train yourself to endure discomfort, to stay calm when others panic. This is less about intelligence than about temperament. Temperament, in fact, might be the single greatest financial skill. It is the ability to stick to a plan when times get tough. It is patience, discipline, and calm. Most financial strategies are simple. Save consistently, diversify, invest for the long term, but they are hard to follow because our emotions get in the way. Discipline is what bridges the gap between knowing and doing. Housel also highlights the importance of defining your own game. Too many people make financial decisions based on what others are doing. They see someone else buying crypto and jump in, not because it fits their goals, but because they fear missing out. But personal finance is exactly that, personal. What works for one person may not work for another. A billionaire can take risks that would destroy a middle-class family. A retiree needs stability, while a young worker can afford volatility. Playing someone else's game is a recipe for regret. This is why clarity about your goals matters. If your goal is independence, focus on saving. If your goal is legacy, focus on building enduring wealth. If your goal is comfort, avoid unnecessary risk. There is no universal right answer, only the answer that fits your life. The sooner you stop measuring your success by other people's yardsticks, the happier you'll be. At its heart, money is a mirror. It reflects your values, your fears, and your desires. It tests your ability to delay gratification, to manage envy, and to balance today with tomorrow. The spreadsheets can tell you what's mathematically optimal, but they can't tell you what will make you happy or what you can actually stick to. That part is up to you. Housel wants us to remember that the hardest part of money is not earning it or investing it. The hardest part is staying sane while living with it. Greed, fear, envy, and pride, these are the real enemies. Mastering them is more valuable than mastering any financial formula. Because in the end, wealth isn't about having more. It's about needing less and being at peace with what you have. The world of money is full of surprises. What seems stable can collapse overnight, and what looks hopeless can rebound with astonishing speed. History proves again and again that the biggest events are the ones no one sees coming. These are the tail risks, rare, extreme outcomes that shape the course of everything that follows. Morgan Housel reminds us that most of history is driven by outliers. In investing, for example, the majority of returns come from a handful of extraordinary days or a small group of high-performing companies. Miss those, and your results look mediocre. Catch them, and the outcome can be life-changing. In broader history, too, tail events dominate. A single war, a sudden technological breakthrough, or a global crisis can alter the trajectory of nations and markets. The danger is that we tend to plan as if the world is predictable. We expect tomorrow to look like yesterday, and we dismiss possibilities that seem too extreme. But the improbable happens more often than we care to admit. Nobody in 2006 predicted the global financial crisis that erupted in 2008. Few foresaw the pandemic that froze economies in 2020. Yet these events reshaped millions of lives, fortunes, and careers. If extreme events are so influential, how should we prepare? Housel's answer is not to predict them, but to respect them. You don't need to know the exact form a crisis will take. You just need to accept that crises will come. This mindset encourages humility and flexibility. Instead of trying to forecast the next big shock, build a financial life that can withstand shocks of any kind. That's why the margin of safety is such an important principle. It means structuring your finances with room for error. Save more than you think you need. Take on less debt than you can technically afford. Leave yourself the ability to absorb surprises. A plan that works only if everything goes perfectly is a fragile plan. And in a world where tail risks exist, fragility is dangerous. Consider how investors sometimes overreach. They borrow heavily to amplify returns, confident that markets will keep rising. It works, until the one time it doesn't. A sudden downturn wipes them out, not because their strategy was always wrong, but because it couldn't survive a tail event. Contrast this with the cautious investor who earns slightly lower returns but stays solvent no matter what. Over decades, it is the cautious one who ends up ahead because survival is the foundation of compounding. Survival is a theme Housel returns to often. Endurance matters more than brilliance. You don't need to be a financial genius to build wealth. You just need to avoid catastrophic mistakes. Compounding rewards those who simply stay in the game. The investor who earns a steady 7% return year after year will eventually surpass the one who swings for 20% but occasionally loses everything. This lesson extends beyond markets. In careers, relationships, and health, staying power beats short bursts of brilliance. A company that avoids collapse during hard times can eventually thrive. An individual who avoids ruin during crises can eventually prosper. In the long run, resilience is a greater advantage than aggression. Another important point is that humility protects you from overconfidence. When things go well, it's tempting to believe it's all due to skill, but often luck plays a bigger role than we admit. Recognizing this keeps you cautious. It prevents you from assuming success will always repeat. It reminds you to respect risk even when you feel invincible. Humility also helps you accept that the future is unknowable. Forecasting is seductive. People love to hear confident predictions. But most forecasts fail because the world is too complex. The best investors are not those who predict perfectly, but those who admit they can't predict and instead focus on building durable systems. Warren Buffett, for example, never tries time markets. He invests with a margin of safety, knowing that shocks will come, but also that strong businesses endure. This is why flexibility is as valuable as foresight. A rigid plan breaks under stress. A flexible one adapts. Flexibility might mean keeping more cash than seems efficient, so you have options in a crisis. It might mean avoiding commitments that lock you into one path. It might mean defining success not as hitting a specific number, but as being able to handle whatever life throws at you. Housel also warns about the narrative fallacy, our tendency to explain events in hindsight as if they were inevitable. After a crisis, people say the signs were obvious, but at the time, the picture was always blurry. Believing the past was predictable makes us overconfident about predicting the future. We forget that uncertainty was real. To guard against this, we must remind ourselves that the future will always feel uncertain, even when later it looks obvious. What this all comes down to is a philosophy of endurance. Don't aim for perfection, aim for survival. Don't try to be the smartest, try to be the most resilient. Don't put yourself in a position where one bad break can erase years of progress. If you can avoid ruin, time and compounding will do the rest. There's a certain peace that comes with this mindset. You stop obsessing over every short-term move. You stop believing you must outsmart the market. You stop comparing yourself endlessly to others. Instead, you focus on the simple question, can I stay in the game long enough for compounding to work its quiet magic? Tail risks will always exist. The world will always surprise us. That truth is not a threat, but a guide. It tells us to be cautious, to be patient, and to respect the unknown. It reminds us that wealth is not built in straight lines, but in jagged, unpredictable paths. And it reassures us that we don't need to know the future. We just need to prepare for its uncertainty.
There's a simple but powerful question at the heart of money. How much is enough? For many people, the honest answer is elusive. No matter how much they earn, save, or achieve, the finish line keeps moving. They reach one milestone only to set another higher. This endless race creates stress, greed, and risk-taking. Morgan Housel argues that knowing when you have enough is one of the most important financial skills and one of the rarest. We live in a culture that glorifies more. Bigger houses, newer cars, higher salaries, faster growth. On the surface, this seems natural.
Ambition drives progress, but unchecked, it becomes a trap. If satisfaction is always tied to the next upgrade, then happiness remains forever in the future, never in the present. You may win the race for wealth, but lose the game of contentment. Housel tells the story of investment manager Rajat Gupta, once one of the most respected figures in global business. Despite immense success and wealth, Gupta wanted more. He engaged in insider trading, seeking just a little extra profit, and ended up losing his career, reputation, and freedom. The lesson isn't about legality alone. It's about the danger of not recognizing enough. When the concept of enough doesn't exist, risk becomes limitless, and collapse becomes likely. Contrast that with Warren Buffett, who famously still lives in the modest house he bought decades ago despite having billions. Buffett understands that beyond a certain point, more money doesn't change your life meaningfully. He focuses instead on what money enables: freedom, peace of mind, and the joy of doing what you love. The lesson is clear. Wealth is not about having everything. It's about needing less. This brings us to one of Housel's central ideas. The highest form of wealth is freedom. Freedom to control your time, to wake up and decide what your day looks like. Freedom from financial stress, from dependence on an employer you dislike, and from obligations that drain your energy. Money, at its best, buys independence. That independence, more than luxury, is what makes people truly rich. Think about the moments when you felt happiest. Chances are it wasn't because of a new purchase, but because you were doing something meaningful on your own terms, spending time with family, traveling, creating, resting. Money that buys those moments is well spent. Money that traps you in a cycle of chasing status is poorly spent. Another subtle point Housel makes is that wealth is often invisible. Richness is not the flashy car in the driveway. It's the financial cushion you don't see. True wealth is money saved, investments compounding quietly, and debts avoided. But because we don't see wealth, we tend to chase what we do see: displays of consumption. This is why so many fall into the trap of overspending. They think showing wealth is the same as having it, when in fact the opposite is often true. To break this cycle, you have to shift the metric of success. Instead of asking, "How do I look compared to others?" ask, "Do I have the freedom to live how I want?" That reframing makes it much easier to define. Enough isn't about beating others. It's about reaching a point where your needs and desires are met without constant striving. Of course, defining enough requires self-awareness. Some people genuinely thrive on growth and challenge. Others value stability and calm. There is no universal number or lifestyle that equals enough. The danger lies not in ambition itself, but in blind ambition, chasing more without ever asking why. If you can articulate what enough looks like for you, you gain a compass that prevents reckless decisions. This ties directly into the idea of contentment. Studies consistently show that happiness rises with income up to a point, enough to cover basic needs and provide security. Beyond that, additional income has diminishing returns. What matters more is how money aligns with values, using it for experiences, generosity, and autonomy rather than just accumulation. Generosity, in fact, is another theme. When money exceeds your needs, sharing it often brings more fulfillment than keeping it. Giving creates connection and meaning. It reminds you that wealth is not just a private trophy, but a tool that can improve lives. In this way, generosity is both a sign and a source of enough. Housel also touches on the importance of independence in relationships. Money stress is one of the biggest causes of conflict between couples. But when both partners feel financially secure and aligned on what enough means, harmony grows. Defining shared values around money is just as important as managing the numbers.
Perhaps the most liberating idea is that you don't need extraordinary wealth to live richly. If you have control of your time, meaningful work, supportive relationships, and enough resources to cover your needs, you already have what many billionaires lack: peace. The comparison game makes this easy to forget, but step back and you realize that contentment is within reach for far more people than society suggests. To illustrate, Housel shares that many lottery winners, despite sudden millions, end up unhappy or bankrupt because they never learned the concept of enough. Meanwhile, ordinary families who live within their means, save diligently, and prioritize freedom often enjoy lives of deep satisfaction. Wealth is not about the number in your account. It's about the relationship you have with that number. The conclusion is simple but profound. Enough is a superpower. It shields you from greed, from envy, and from ruinous risk. It grounds you in gratitude and allows you to use money as a tool rather than being used by it. Without enough, you're forever restless. With enough, you're free.
The journey through money and behavior ends with a lesson that may be the most important of all: perspective. Money is never just about numbers. It's about stories, emotions, and the meaning we attach to them. The way we think about money shapes not only our bank accounts, but also our happiness, relationships, and legacy. Morgan Housel reminds us that people view money through different lenses. What looks like a reckless risk to one person may look like a necessary bet to another. A startup founder pouring everything into her idea may terrify the cautious saver, but for her, the gamble is rational because it aligns with her values and dreams. Likewise, the saver who prioritizes safety over growth may seem timid to the risk taker, but he is simply protecting what matters most to him. Neither is wrong. They're just playing different games. This idea of different games is critical. Financial markets are not a single contest with one scoreboard. A day trader trying to make fast profits plays a different game than a retiree living off savings. A hedge fund speculating with millions plays a different game than a family saving for college. Problems arise when people forget this. They copy strategies from others without realizing those strategies fit a different game. The best investors know which game they are playing and ignore noise from those who are playing something else. Another point Housel emphasizes is that money decisions are often less about rational calculation than about avoiding regret. People don't want the mathematically perfect strategy. They want the strategy that feels right to them, the one they can stick with through ups and downs. A portfolio that looks suboptimal on paper but keeps you calm is better than one that promises higher returns but causes panic and sleepless nights. Behavior beats spreadsheets. This connects to the power of storytelling. Humans make sense of the world through narratives, not statistics. A compelling story about how a company will change the future can drive stock prices higher than balance sheets alone justify. A personal story of hardship or triumph can shape how someone uses money for decades. That's why money advice that ignores psychology often fails. People don't just want numbers, they want meaning. Luck and risk, too, deserve a final word. We're quick to credit ourselves for success and blame others for failure, but luck and risk weave invisibly through every financial outcome. Bill Gates became one of the richest men in history, partly because of brilliance and hard work, but also because he happened to attend one of the few schools in the world with a computer at the right time. Countless equally smart students, without that luck, never had the same chance. Recognizing the role of luck makes us more humble and more compassionate. It softens judgment of ourselves and of others. At the same time, it doesn't mean success is pure luck. Hard work, discipline, and decisions matter enormously. The balance is to acknowledge both forces. Luck shapes opportunities. Choices shape outcomes. Accepting this duality helps us stay grounded. So what does all of this mean for living a good financial life? Housel distills it into a handful of timeless principles. Save consistently, not because you know what's coming, but because you don't. Be humble in success and resilient in failure. Avoid the trap of endless comparison. Focus less on maximizing returns and more on ensuring survival. Define what enough means for you and protect it fiercely. Remember that money's greatest value is the freedom it buys. When you see money this way, it stops being a scoreboard and becomes a tool for independence, for security, for creating experiences that matter. You realize that the richest person is not the one with the most, but the one with the least need for more. And perhaps the greatest perspective of all is that money is just one part of a bigger life. It matters, of course. It pays the bills, it shapes choices, and it eases stress. But it is not the only currency. Time, relationships, health, and purpose, these are currencies just as valuable, sometimes more. Money should serve them, not replace them. So, as you finish this journey through the psychology of money, take a moment to reflect. What does wealth mean to you? What game are you playing? What would enough look like in your life? If you can answer those questions honestly, you'll already be ahead of most. This isn't about mastering Wall Street or chasing secrets. It's about mastering yourself, your patience, your perspective, and your emotions. Because in the end, money is less about math than behavior. And behavior is something we can all work on, regardless of income or background. So, here's the call to action. Don't wait for the perfect strategy, the right market conditions, or a sudden windfall. Start now with what you have. Save a little more than you think you need. Take fewer risks than you can handle. Focus on building flexibility instead of perfection. Protect your downside, stay in the game, and let time and compounding quietly do their work. And above all, remember, the real goal is not to be rich. The real goal is to be free. If you found value in this summary, don't forget to hit that like button. It really helps more people discover these ideas. Subscribe to the channel if you want more deep dive book summaries that can change the way you think and live. And I'd love to hear your thoughts. Drop a comment below sharing your biggest takeaway from the psychology of money. Was it the idea of enough? The power of compounding? Or maybe the reminder that luck plays a bigger role than we admit? Until next time, keep learning, keep growing, and remember, true wealth isn't about having more, it's about needing less.